Coming up today, stocks have a sharp pullback as tariffs on China increase again. The US dollar has a huge drop. Will Chinese stocks get delisted? Inflation cools, and a bond vigilante's playing chicken with the president. We're going to cover this and a whole lot more in today's show, guys. Let's go. And it's gone. And just like that, back down we go. Giving up almost half of yesterday's monster gain, the record day we had in the markets. And as I said in yesterday's video, we're not out of the woods just yet. We shouldn't expect a V-shaped recovery because there's still so much uncertainty present in global financial markets. Big trade deals are likely to take some time and could very well be a messy process to eventually get done. Plus, we've still got volatility and backwardation, and that's why I said we should expect plenty of up and down movement as this market is still on edge here, adapting to a whole new world order created last Wednesday afternoon. And so that's exactly what we're getting here today. A little bit of a defensive move, but overall a risk-off day in the growth shares. And just looking across other financial markets, we had the dollar had one of its worst days ever, down over 2.3% against the euro and the yen, and almost 4% against the Swiss franc. We'll see how gold surged to another record high, along with a strong rip in the miners. Treasury bonds still getting clobbered, and Bitcoin falling a bit too, all of which I'll get into on the charts later on. And stick with me today, because in this video, I'll show you one of the short volatility options trades I put on today, along with my reasoning behind it, which I think you'll find really interesting. But just to show you some interesting and relevant stats first. It's hump day for the win in 2025. Wednesdays are tracking at a huge annualized return of 256%, thanks to the monster move we got yesterday. And it's days like today, Thursday, which has been the worst day of the year so far. Friday hasn't been that much better either. No doubt plenty of traders and investors going to be nervous going into this weekend as there's still so much headline risk out there, as this market is getting pushed around a lot day to day depending on the headlines we get, which of course are very hard to predict, hence why short-term trading is very difficult as you're trying to make decisions on an uncertain future, especially at this time. And we may be approaching records for how long the fear and greed index has stayed depressed. Now coming up 2 months since we've been stuck down here. And the demand for stock market insurance is off the charts. That is put options. In fact, the 5-day average on the value of puts being bought is greater than that from March 2020. And there's a look at the 25 most traded options in the market. And not only have we got more puts being bought on the indices, which is not all that unusual as they're mostly used for insurance, we're also getting skewed volumes on some of the biggest stocks as well. People buying puts on Tesla and Nvidia, Apple and AMD also sticking out with some lopsided volumes going on there, especially Dollar Tree. No doubt a lot of people are worried about where all their cheap goods are going to come from now, as everything is still up in the air here. Prediction market swinging around as well. Yesterday we were looking at a 53% chance we'll get a recession. Here we are today, 63. Market flickering back and forth. And I guess the longer this uncertainty goes on, it's kind of the more damage that will be done. This market really needs some big global trade deals to get done soon, which we could be on the cusp on. I'll show you news on that in a minute. And so if your portfolio is taking a bit of a haircut this year, don't worry, you're not the only one. Some of the richest people in the world are also having quite the drawdowns here. Elon Musk down over 200 billion. But of course, the true exception, Warren Buffett. He's actually up on the year, thanks to his holdings in Berkshire Hathaway, which has kind of been his lifelong hedge fund. And that's thanks to his low leverage, exposure to over 100 stable businesses, mostly with predictable cash flows. The types of assets he likes, and of course, about 30% of the company in T-bills, short-term liquidity, which fundamentally has helped it hold up, but also there's been a bit of flight to safety in Berkshire Hathaway. A little bit of a multiple expansion in this time versus the rest of the market that's compressing. And so hats off to Warren Buffett. He is known for outperforming in bear market, and he's certainly got the most amount of dry powder available, potentially pick up a big bargain at some point this year, I think is highly likely, especially if rates keep coming down. But otherwise, investors are persistently nervous. We just got the latest AAII investor sentiment survey. Once again, coming in very weak. Did get a little bit of a bump up on bullish feelings. No doubt yesterday helped. But we've now gone 7 consecutive weeks with the bearish reading above 50%. That's only ever happened once before in history, the savings and loans banking crisis, which gave us a recession in the early 90s. And that did mark the low. And a good time to buy stocks. Is this time different? And just looking at sentiment traders, smart money, dumb money, confidence spread. And I know this term comes with negative connotations, as it is implying us retail investors. However, I don't think it should be interpreted that way, as this indicator looks at quite a few things for extremes and positioning, options, so on and so forth. We've now got the highest reading in favor of smart money since 9/11, which wasn't the bottom in the market, as that bear market still had another year left in it. But typically, spikes in this indicator do correlate with bottoms, just like vice versa as well. When this indicator gets low, it can indicate the market may be peaking a little bit. And I know this chart here is a little blurry, but what you're basically looking at is the S&P 500's returns indexed to when we have a 2-day change in the VIX that rises at least 20 points. So here in the blues, 1987, in the red, 2015, in the green, 2018, and in the yellow here, 2020, and in the dark yellow, where we're at currently. As we can see, returns for the next month or two can be quite messy, consolidating. Then the market kind of finds its feet and can drift a bit higher, sometimes a lot better, especially if we get the government and the Fed step in like they did in 2020. A little bit different though was 2018. We had a huge sell-off coming into Christmas there, but we did get that V-shaped recovery. But what does correlate with big corrections in the stock market is the health of the jobs market. How many people are unemployed? As you can see in this scatter plot, the peak to trough equity correction, that's basically the drawdown in the stock market, with larger drawdowns on the left here. And on the left label is the trough to peak increase in the unemployment rate. So how far does the unemployment rate go up? And so what we can see from this chart here is when the jobs market really takes a hit, like it did in the GFC, we get a much bigger correction in the stock market. However, we've had recessions where the stock market hardly goes down. Early 80s, early 90s wasn't that bad either. But typically speaking, spikes in the unemployment rate correlate with bigger drawdowns, but you got to remember, jobs data is somewhat lagging. That's why we look at consumption, CEO confidence, hiring plans, credit card data, and other things to try and give us a heads up. And that's because markets can quite often bottom before the economy does. We especially saw that back in 2020. Earnings per share actually bottomed 13 months after the stock market, and there was a huge multiple expansion thanks to a massive injection of liquidity into the market, which overwhelmed the fundamentals and expectations. Even though earnings were contracting in that time, the market shot up. Same with GDP. You'll see this a lot as well. It can bottom out just after the stock market. Typically, the market is 3, 6, sometimes even up to 12 months ahead of the economic data. And this is one big reason that makes economic forecasting very challenging at best. And just looking at an updated analog of the S&P 500's highest correlated declines from a 3-year high with what's happening now. We're here in the blue. Obviously, nothing like 2017. Volatility was really low. 2022 bear market, we're actually tracking ahead of. 2005, not really the same. The roaring bull market of the 90s peaked out in March 2000. If we were tracking like that, we're already doing worse. But actually looking at this comparison chart here, it's actually 1990 and especially 1998 that is actually looking almost like lockstep, a mirrored image of the market back then, where the LTCM crisis, big leveraged hedge fund blew up, the Fed and Wall Street had to step in and bail them out. We got a big bounce, retested, put in a double bottom, then blew everyone away by how much it shot up over the next year and a half. And just looking at these previous years, not really as similar compared to what we saw in 1990 and 1998. And so it all comes down to corporate earning. The company's going to keep making a lot of money because forward PEs now, valuations on the market and the sectors are quite reasonable after this sharp correction we've had. In fact, the S&P 500's forward PE ratio is now 18.2, which is actually a little bit lower than the 10-year average. Same with tech stocks. Look how much the valuation multiple has contracted over the last 6 months. July last year, we're over 30. Here we are at 21. There's a look at financials, comms, healthcare, discretionary, all below 10-year averages. Industrials, not quite. It's actually consumer staples, the most overvalued, looking at forward PEs relative to history. Energy, exceptionally undervalued still, 12.8 times earnings. That's got the overhead pressure of a weak crude oil price. REITs also cheap relative to history, and same with utilities, which I'd say is one of the most appealing sectors on a valuation basis here, given their defensive nature if we are going into a bear market, possible recession. Not to mention they have upside potential as well on the back of the boom in demand for electricity, thanks to AI data centers and the huge amounts of power they require. And I'll show you later on the weekly charts of all the sectors and which ones are looking the best to me. And so we just did under a 20% correction on the S&P 500, quite a bit more on the other indices, but looking back in history, if the market did put in a low on Monday morning when we opened up to doomsday fears, and the correction is contained within 20%, that is pretty good stats going forward. We're higher month, 3, 6, and 12 months, 100% of the time. And especially when we have a big monster gain in the market like we got in the S&P yesterday, almost 10%. Typically gains above 5% give us really good forward returns 6, 12 months out, with the average returns being a lot higher than usual. But as I was saying, it can be a bit messy in the short term. Even 3 months later, we're only higher a little bit more than half the time. But in the following days and weeks, it's really messy and still volatile. And that's exactly what we're getting today. And we can see that on the spider chart here. Big gap down to start the day, sold off, bit of a buy the dip. And I'd say it's likely we could chop around here for a few weeks. And yesterday was more of a uncoiling, short covering, as opposed to the start of a new V-shaped recovery to new all-time highs. which I'd be very surprised if that happened anytime soon. We'd have to get some blockbuster global trade deals done, but even still, there's plenty of risks and uncertainty with issues surrounding China, and the world economy still needs a massive rejigging of supply chains. And what could China do back is also another risk. And the White House just dialing up the pressure on China even further, actually coming out and clarifying today the tariffs are not 125% on China, they're actually 145%, as the 125 announced yesterday did not take into account the 20% tariffs that had already been levied on them a few weeks back. So that is a huge disincentive to do any trade with China if you're an American company. And no doubt importers that have solely relied on China are facing a huge crisis and probably scrambling to shift their production. Because basically all goods coming from China into the States are now going to be 145% more expensive. Strong incentive to produce elsewhere or buy local made. And so we got a big pivot yesterday, just hours into global tariffs officially going into effect. Was the president's hands forced by bond vigilantes, so-called big holders of treasuries, potentially dumping, which causes yields to spike? Got Treasury Secretary Scott Bessent a little nervous, along with the president who did say he was watching the steep sell-off in bonds before he paused his tariffs on Wednesday. Quoted as saying, "The bond market is very tricky. I was watching it, but if you look at it now, it's beautiful. The bond market right now is beautiful." And so maybe the White House wasn't expecting a huge, sharp jump in yields. And so was it a bit of a game of chicken, in which the famous analogy was two cars driving towards each other, which one is going to get out of the way first? And so we got an interesting move in the bond market today on the back of cooler inflation than expected. We actually had the 2-year pull back to 386 short-term yields, but once again we got a steepening, the 10-year holding ground here at 442. Remember, we started the week on a 3 handle. It's been a huge jump in long-dated bond yields this week, which no doubt would have been making Bessent nervous, especially in the early hours of yesterday morning when they were sitting around 450. So no doubt this played into their decision, but that doesn't mean they still can't achieve their original objectives of reordering global trade to be a more equal and level playing field, as well as isolating China, for which many people seem to think China has immense leverage and control over US bond yields. Seeing it all throughout my social media feeds. China's dumping treasuries caused yields to spike, forced the president's hand. I don't think so. And that's because China doesn't even own $1 trillion of the US's now $36.5 trillion debt, as this data is a year and a half old, and there's been $2 trillion more in debt added in that time. Japan actually owns more, and so no doubt both of them were likely selling treasuries, but also other holders as well. But to say that China has complete control over US interest rates, I think is a factually incorrect argument, but no doubt they do have some influence. But it's actually the Fed who's the elephant in the room, along with state, local governments, mutual funds, and pension funds as well, for which there is still good demand. We saw that yesterday, we saw it again today in a 30-year auction, with the sold yield actually coming in lower than expected, and foreign investors actually bought up 62% of it, which is only a little bit below the average 67%. So don't be fooled, the US still has the reserve currency, and US treasuries are still the lowest risk asset in the world. But no doubt big foreign holders of USD assets are selling, just as they have been pretty much all year. Looking at the dollar here, and we just took out lows again today. Really sharp falls. There's a look at the euro dollar, the dollar yen, and the dollar franc actually took a sharp fall today, along with another sharp fall in TLT. But we got that monster hammer yesterday. Could this potentially be about to find some support soon if we've seen a little peak in yields after this week's episode? I was eyeing up some bullish trades in options this afternoon, but I didn't pull the trigger. However, I may tomorrow if we get down a bit lower, or even take out Wednesday's low. With implied volatility so elevated, I was potentially looking at a risk reversal, and that is selling the 86 put and using the credit from that to finance a purchase of an 88 call with a target of about 90.91 as a potential trade idea for tomorrow I've got on my list. And stick with me, because later on I'll show you the short volatility options trade I took with my reasoning behind it. So the EU appears to be playing ball for now. They did bite back a little bit, but they too have paused their tariffs against the US for 90 days. I believe it's highly likely we're going to get deals done, but what goes on with China is a whole different story. They're now being isolated, separated, and treated completely differently from the rest of the world. As I said at the start of this week, that was the main objective of this campaign to begin with. Along with leveling the entire global field of trade, they're just separating and punishing the worst abuser of that, which has been tolerated for far too long. And as I started saying last week, I thought the risk of Chinese ADRs, American Depository Receipts, basically Chinese stocks that trade on the mainland or on Hong Kong that are also dual listed in New York could get caught up in all this and potentially delisted. And we've been hearing news of that from the admin that they're thinking about it, and hence why I've already completely exited all my Chinese headquartered stocks. I have zero exposure to companies headquartered in China or Hong Kong. Because even though this may not happen, I'm totally fine if it doesn't. I'd rather just step aside for now and let this all play out, as it could still dial up further with the tit for tat between the States and China. Because as Scott Bessent said, everything's on the table. And this is a big deal because there are 286 Chinese companies listed on US exchanges with over $1 trillion in market cap. That'll be a huge headline if they go after that, which would make sense because they're trying to cut off China. And again, why should American investors, or pretty much global investors on US exchanges, finance Chinese companies and their growth if they've been targeted? And so as a long-term Tesla shareholder, I do worry they could potentially also get caught up in this. If the US admin goes after Chinese stocks in New York, maybe China, in their true fashion, bites back in kind, because Tesla is doing really well at the moment in China. But I'd say they'd be looking at this because they don't want a huge blowback from consumers who love the brand over there. At the same time, they have to do something. Either Tesla, Apple, Starbucks, Nike, all these big American brands that operate over there, maybe they don't completely shut them down. Maybe they just make business a lot more harder. So consumers can still buy the products. The consumers don't really notice anything different, but behind the scenes, the companies are getting grilled. And so that's something I do worry about and could be an issue going forward as well. Because a big part of Tesla's valuation has to do with its strong presence in China and all that potential going forward. Again, it's just something that's hard to predict at this stage. But the possibilities for something bad happening over there to all big American companies that operate there has shot up a lot. But then again, the waltz bottom may hold as well. So Bessent's certain this is all going to have blown over. Within 90 days, they'll have big global trade deals done, massively in favor with the states, and then we should be back to business as usual. Same deal with the Secretary of Commerce, Howard Lutnick. He still thinks the golden age is coming. We are committed to protecting our interests, engaging in global negotiations, and exploding our economy. And so it's a bit of a race now to get these trade deals done. China versus the states. No doubt both sides are approaching key players in this, Vietnam being one of them. And that's why we heard also today from Bessent, during today's meeting to confirm the start of formal discussions on reciprocal trade with the Deputy Prime Minister of Vietnam, I emphasized the need for continued engagement and quick, demonstrable progress to resolve outstanding issues. In other words, let's quickly get a deal done. Vietnam and China don't really get along, and this is actually their opportunity to do a solid for their economy, more closely align with America, increase trade between the two, American technology to Vietnam, buying way more from them, and can help millions more people in their country become gainfully employed and more prosperous. So that's the macro picture, but just looking at companies, we're going to hear banks start reporting their earnings tomorrow. EPSs should still be holding up for the most recent quarter. More importantly, will be their outlook and guidance. Are they going to guide down? Are they already seeing deterioration in lending? We're going to get a good feel of that tomorrow morning before open. We hear from JP Morgan, Wells, and a few others on their latest earnings. And what about big tech? Are they going to keep spending big on AI? Well, for now, we've heard that they will, but no doubt they're going to be looking at this. If this goes on for a lot longer, they may be forced to dial it down by the market. Otherwise, I think they'll still want to stick with their long-term ambitions, because they'll be worried if they slow down their spending, maybe their competitors won't, and this will be their chance to overtake them. We also got inflation coming today, much better than expected. 2.4% year-over-year growth, down from 2.8% in February, with core running at 2.8%. And there's a look at the raw data on core inflation. Pretty good drop there, 2.8%. And we may in fact be breaking out to a new lower low. We had been going sideways for over half a year here. However, we just printed a lower low. This downtrend looks to be still intact. And that's actually confirmed by what we've been seeing with Trueflation. As I've been saying over the past month, there's a divergence between government CPI and prices in the actual economy, which Trueflation measures. So it looks like that gap could be closing and we're trending in the right direction. We did just get a low CPI print, which obviously was pretty much ignored by the market. It's so running hot on tariffs here. Normally this would bring yields down and stocks up as the market could start getting excited about lower rates, which Fed fund futures are still pricing in. 1 in 4 chance the Fed may cut in 3.5 weeks when they meet next month. Otherwise, 85% chance they'll cut in June. And why shouldn't they? This is Jay Powell's window of opportunity. Get rates down. Allow the government to refinance a huge amount of debt. Take this chance while you can, because it's very likely we get trade deals done with other countries. And whilst a 10% baseline tariff is likely to remain intact, that's no big deal. It will make things a little bit more expensive, but US companies can keep importing cheap goods into the country while still incentivized to produce at home. And so if corporate earnings don't fall off a cliff, but rates can come down, that's still technically a solid soft landing, even though I know that sounds a bit crazy to think of in this current environment. Inflation in China as well is coming down. They've actually got deflation in their producer prices. And that's good because it has a global effect. If they've got inflation and causing commodities to go up, we all pay a higher price for everything. And there's a look at the latest global rates. A little mixed, but overall the trend year-over-year CPI around the world is mostly lower. And that's why we're still in the middle of a global easing cycle. The most recent decisions by the majority of central banks has been to cut, bar Japan and a few others, Norway, Brazil, Russia. But overall, global rates are getting lower. Okay, as promised at the start of this video, I'm going to show you an options trade I put on today and give you my reasoning behind it. But first, let me just explain to you what an iron condor options trade is. So this type of trade is a short volatility trade, and it's good when implied volatilities are high and you think the stock may consolidate, bump around. Say, for example, a stock's currently $100 a share, and you think over the next week, two, or whatever, the stock should likely stay in between $105 and $95. So how you can express that view in the market is by selling a $95 put, and to protect yourself and lower your trade margin, you also buy the $90. That in itself is a bullish put spread. And vice versa, put on an iron condor, you would sell the 105 call, and to cap your risk, you would buy the 110 call. And so this trade structure creates this payoff diagram. And I can see since the max profit's $200, that's the net credit. $2 per share is 100 shares per option contract. In other words, if the stock expired in between 95 and 105, you'd make $200. If it expired at 93 or 107, you'd break even. But if it expired below 90 or above 110, you'd realize your max loss of 300. And so that's called an iron condor. And so this is one of the trades I put on today in my options trading account. It's not exactly a plain iron condor. It's rather what I call a reverse iron condor or a bearish iron condor. And I did this on the VIX ETN, VXX, for options expiring next Thursday, which is the regular monthly OPEX we normally get on the third Friday of the month, but next Friday is Good Friday for Easter, a public holiday. Stock markets will be shut. So regular monthly options are expiring next Thursday. And there's a look at the VXX ETN, exchange traded note. Pretty much mirrors the VIX, as that's what the volatility index has done over the past couple of weeks. However, it doesn't mirror completely the VIX. The VIX is a spot index for reference. You can't actually trade the actual VIX. And so what this ETN does is constantly holds a position in the VIX front month and second month futures. It always has to roll, selling the front month, buying the second month. And typically we have what's known as contango in the volatility term structure. And that is options that expire 1 month, 2 months, 3 months, and so on. Typically have higher volatilities the further out we go. That's called contango. Because the volatility is low right now, the chances in 3, 4, 6 months we see a spike in the VIX are pretty good. And so you can't just buy spot VIX because you're basically guaranteed to make money. It's a little harder than that. However, in times of market stress, the volatility term structure flattens, then it eventually goes into backwardation. And that's what we've got now. Volatility at the front is a lot higher than out the back. Options market pricing and volatility will come down. And this is what VXX benefits from when the term structure goes into backwardation. However, most of the time we're in contango, and it always goes back into contango. That's guaranteed. And hence why if you go out to a monthly chart on VXX, that decay from constantly rolling, in fact I have to go to logarithmic here, that decay from constantly rolling the front month to the second month, and the term structure is mostly in contango, just causes it to structurally lose money. It's lost over 99% of its value. It's really just a short-term trading vehicle. And so let's just bring up my trade structure here, and I'll give you my thinking behind it as well. So for options expiring next Thursday, got 5 trading days, tomorrow and 4 days next week. What I've done is I've sold the 75 call, as we can see here. To protect myself, I bought the 90 call. Now that in itself is called a bearish call spread. Benefits if the price comes down. And at the same time, I put on a bearish put spread. And that's why I call this a bearish iron condor. Because I've also purchased the 75 put and I've sold the 65 put to bring in a bit of premium. And so this is what the payoff looks on this trade structure of mine. This is a bit of a go-to trade structure for me on VXX. I actually did the same trade on Tuesday afternoon and took it off yesterday afternoon because it had reached the majority of max profits. So this is the profit and loss of how this trade will progress. With the dates up the top here, there's expiry. And so the max loss on this 2 contract trade structure is $2,300 with the max profit $2,600. And you can see I've got a little bit of time on my side. Now, if volatility moves up, you can see the trade losses accelerate with time. Even if we stay at the same level on the VXX, The opposite is true. We go below my break even, gains accelerate with time. However, the VXX pretty much finished at $80 today. And so if we were to move up tomorrow, the next day, we very well could. I'm not saying VIX has hit a top. This is just one trade of mine. May result in a loss, may result in a win. I just like the odds here, and I'll explain to you why. If VXX moved up to 100 tomorrow, I'd be looking at about $1,100 open loss. However, if it moved down 20 points to 60, I'd be looking at almost double profit, 2,000. And even till expiry, if VXX moved up 20, I'm looking at a loss of 2,300. If we move down 20, I'm looking at a win of 2,660. So working out the difference between a similar move down or up, that's the market implying there's about a 47% chance we move to 60 versus 100 because the payoff's greater if we go down 20 versus up 20. And that's why I put on the trade, because I believe the odds are greater than 47% chance we move down to 60 by next Thursday. I think they could be 60 or 70% odds because we always get that VIX crush. And I can manage the trade. Ideally, we get a crush soon, then I can lock in the gains. And even if we keep falling below my short put level of 65, I'm still covered because I'm long the 75 put. And so my thinking behind this is the big events already happened, really happened last Wednesday. New global tariffs, then they've just been dialed back yesterday. And whilst we still have plenty of headline risk, anything could happen. We could wake up to something with China and Taiwan, which would send volatility screaming. But that's why I've capped my risk, because just shorting the VXX, even though it's guaranteed to fall over at some point like it always does, comes with significant tail risk in the short term. You don't want to blow up. I never put on a trade that can potentially blow up my account. And if we did shoot up tomorrow, and I didn't think the fundamentals were justifying it, I very well may roll up this trade or do something else, depending on how I see it. But that's my reasoning behind the trade. Like I said, it's not guaranteed to work out. I just like the odds on it, the probabilities and the payoff. I think there's a greater chance this falls next week than goes up, but I could be wrong. And as always, this is not financial advice. I'm just sharing with you my opinions and trades and how I see it, in the hopes that you can learn something from this as well. So I'm interested to hear from you guys what you think about this trade and how you think all of this may play out as well, not just volatility, but with China, with tariffs, Vietnam, bond yields. I always enjoy reading other people's perspectives in the comments below this video. And just wrapping up today's show with a few more charts, there's gold hitting all-time highs above 3,200 an ounce. Crude oil seeming to stabilize somewhat, $60 a barrel. And we can see just looking at the crude oil volatility index, OVX, that's shot up a lot this last week and a half, currently at 49. And in addition to TLT, we've also got one of Warren Buffett's favorite stocks, Occidental Petroleum, on my watch list for tomorrow for a potential risk reversal trade, just like TLT, where I'll be looking at selling the $36 put and using the credit from that to finance the purchase of a call option, with the target being the 50-day VWAP or thereabouts, and that's otherwise known as a risk reversal trade. And look at that move in gold miners, breaking out to a brand new 52-week high today on big volume. No doubt investors reallocating to miners here. Certainly a hedge on inflation, and valuations on them still pretty good. And like I said at the start of this video, I'd show you weekly charts on the sectors, which are actually looking somewhat constructive. Potential reversal bottoms maybe have been put in. There's tech, discretionary on the weekly chart, got some reversal signals here. Even retail slammed the last 2 months. Things are looking pretty stretched. Same with home builders, big spinning doji on the weekly chart. Industrials, that's a bullish candle formation. Financials holding up the best going into their earnings tomorrow. Energy got smashed hard last week, but one of the hardest hit sectors, and it's unbelievably very rare you'll see this, the entire weekly candlestick below the buy-sell band here. Massive spinning doji. Biotech, extremely stretched here on the weekly chart. And utilities holding up one of the best. But we do have one more trading session left this week. We'll see what the final weekly candlesticks look like, along with PPI inflation, along with consumer sentiment coming in tomorrow, which will no doubt probably come in really soft as well. Look at that weekly chart on the 10-year yield. It's a huge move. And the spider as well. Just monster volumes this week. And the Russell market is trying to find a floor here, but we get any big negative headlines, we're going to be retesting these lows pretty quick. But I'm still willing to scale into short volatility trades on the days that the VIX does bump up. And I will keep playing it till we get that eventual VIX crush. But I don't think we're going to be seeing 20 anytime soon. And that's pretty much a wrap today for the daily market review. Thanks very much for sticking with Click Capital, and I'll see you back here again tomorrow for the last trading day of the week. Cheers.